Well, hello everyone, and welcome to KiwiTech's Angel Investors Panel. My name is Karandeep Sodhi, and I will be one of your hosts for today's event. We are very excited to have 10 Capital Network as our event partners today. We thank them very much for their support for our Angel Investors Panel and the overall contribution, of course, to the startup ecosystem. Now, as we get started, I would just like also to take a moment and say that we greatly appreciate all of your overwhelming support for this event. Today, we have a great panel that would revolve around how to invest in startups without paying taxes. And the discussion will be followed by four premier startup pitches. Now, with that, I would like to introduce Anita Gupta, the co founder and chief portfolio officer at KiwiTech, to give a quick overview of the company. Anita, over to you.
Thank you, Karandeep. Would love to talk to you guys a little bit about KiwiTech and who we are. Essentially, KiwiTech is an ecosystem, a community of investors and entrepreneurs. And in our ecosystem, we have over 400 portfolio companies that we've invested in, as well as over 2,000 investors that we connect through events such as this. We hold almost 100 events per year. And we have also participated in these startups and these portfolio companies by providing tech services as part of our investment to the tune of about $100 million, and help them raise capital as well from our investor network, about $75 million. Most of our startups are in the US. We are branching out. We have now communities in Canada, Middle East, Africa, Europe, and other areas. How we got here, a little bit about our history. In 2012, we sold our first company. We're a sibling entrepreneur team. We launched a second company that was KiwiTech, and then we started the startup program in 2013. Shortly thereafter, we saw the need to connect startups with investors, and we launched demo days. They were local and in person. And more recently, we went virtual. Right before the pandemic, actually, we had our first virtual event, which was very successful because we were able to connect people from various parts of the world. And that has really led to numerous virtual events. And we're currently on track to becoming an ecosystem of over 1,000 portfolio startups. Our startup partnership model essentially works like this. We take about half of what we would offer in tech services. We take in-kind development for up to about half. And that allows us to really participate with the startup and allows the startup to conserve their cash and increase their runway. So it's a win-win for both. We have helped create deal flow for not only what we're doing, but also for all our partners. The way we do this is we use our marketing team really to reach out to tens of thousands of companies. In the last couple of years, we actually spoke to over 10,000 entrepreneurs and reviewed deals and narrowed it down to about 200 plus that we invested in. And that's really kind of fueled our growth. The ecosystem that we are building contains in it not only the portfolio companies and investors, but also incubators, accelerators, and corporate participants who may want to invest in these portfolio companies or may want to work closely with them. We also offer beyond technology services now. We offer finance and accounting services through a recent acquisition, Graphite Financial, and we're also looking at adding on digital marketing and equity crowdfunding as services. We give our startups the benefit and our investors the benefit of both our local partnerships in each region, as well as leveraging offshore capabilities and keeping costs down. This is a smattering of our ecosystem of events. We have not only events such as this, but we also focus on VC capital and on various niches of entrepreneurs, such as female founders and Black founders. We also have focused on things such as blockchain and different industries like real estate. So enjoy today's Angel Investors panel. It looks to be very interesting. Looking forward to it. Back to you, Karndeep.
Thank you so much, Anita. Thanks a lot. And now, moving on to the exciting part of our event, I would like to welcome our panel moderator, Hall T. Martin, who's the founder and CEO of 10 Capital Network. Hall, over to you.
Great. Thanks, Karandeep. Thank you for having us here today. As you said, I'm Hall Martin with 10 Capital. We connect startups and investors for funding. And today, we're going to talk about how to invest in startups without paying taxes. And this is important to both investors and to startups because as you can reduce the cost of investing, you'll find more of it coming into the startup, and you'll find more people entering the startup category. So let me bring up the panelists we have today. We'll have them come on and talk about who they are and their company and what they do. First up is Chris Palmisano. Chris, can you tell us more about yourself and what your company does?
Yeah, hi everybody, this is Chris. I'm the COO at Rocket Dollar. So Rocket Dollar helps investors invest in alternative assets using a retirement account like a 401k or an IRA. And we've been up and at it for about 3.5 years. And we've got several thousand customers and several $100 million in assets that have flown through Rocket Dollar. Thanks for having us, both KiwiTech and 10 Capital.
Great, thanks, Chris. And next up is Matt Barbieri. Matt, you've been here before, but can you tell the audience again about yourself and your firm?
Sure thing. Well, happy to be here. Thanks for having me again. My name is Matt Barbieri. I'm the partner in charge of media and technology companies at WIS, regional CPA firm headquartered in the Northeast. As a firm, we service about 5,000 companies. We have a heavy focus in media technology. And so personally, my practice area represents high growth tech companies from inception, I would say just past the idea phase when it's, getting the first real investor capital all the way through exit, be it planned exit, IPO, strategic. And so my practice does focus a bit more on financial services like financial statements, audit and attest, though I do dabble in tax, which is what I'm here to talk about today. So I'll see if I can't get us in trouble.
Great. Thanks, Matt. And our third panelist is Joe Milam of AngelSpan. Joe, can you tell us more about yourself and your firm?
Yeah, my background is I used to run a multifamily office out on Sand Hill Road for 20 years and migrated to Austin, Texas. And what we built at AngelSpan is really a public company equivalent investor relations service. So standardized reporting of monthly updates, quarterly reports, where the startups, this is not a do-it-yourself solution. It's very much a model after what the public companies oftentimes have access to. So they very much outsource this function to us and our expertise in areas beyond just the production of the monthly updates and quarterly reports, a lot of other expertise, including QSBS.
Great. Thanks, Joe. So there are many tax credits and different ways to reduce the cost of investing in startups. Today, we're going to focus on the federal ones, the ones that apply to everyone in the U.S. There are all state ones as well that apply to individual groups, and you may want to check those out in your state as well. But we're going to start with the 1202 tax credit and talk about it. First up, Chris, can you tell us more about what is the 1202 and how it works?
Well, yeah, so 1202, as well as the other parts of the tax code that pertain to QSBS, is a section of the tax code that pertains to angel investors who are investing in new companies and how they can get a tax exclusion on a successful liquidity event. I'd actually love to hear from either Joe or Matt, who are the true experts on that specific topic, because and I can talk to you about how you might combine that with an IRA into a grander strategy. But Joe, you want to grab that?
Yeah, 1202 was passed in 1993 and has gone through a number of iterations as late as 2015. So the current law as it stands says that if you're a taxable investor in a C Corp startup, and that startup is in the business of making and selling something, that's the specific language. So largely most startups that are seeking outside capital qualify. Service businesses don't, and retail and professional services and financial services, real estate, et cetera. But what it allows for is if you invest in a startup as a taxable investor under what's called a QSBS qualified term sheet, and you have an exit, and it took 5 years from the time you invested the time there's an exit, then you pay zero taxes on the first $10 million of profits. And that's per shareholder, per deal. And that applies to the founder shares as well. So this is very relevant for the founders of startups. They really do need to be acutely aware of the QSBS details, because there are things they can do, and Matt can probably give you even more details on this, that are called disqualifying transactions that you could be a qualified small business stock and have access to the favorable tax treatment, but do something unbeknownst to you and your shareholders, that then when you have an exit, you don't get the tax-free treatment. So there are some nuances in there, but at its core, it's pretty straightforward, and it's pretty darn easy to qualify with just a little bit of knowledge and a little bit of record keeping ahead of time. It's a great way to enhance your fundraising process. There is a component to the 1202 law called a 1045 exchange, which is very similar to 1031 exchange in real estate, in many ways better, and to a certain degree a little bit more difficult. There's only a 60-day window to roll over profits from a QSBS deal, but we can get into that a little bit later.
Great. Matt, what can you add on about that?
Yeah, so it is a fantastic thing, right? QSBS. The things that I think are important for us to mention at the outset is it's got to be original issue stock. And these are some of the things that cause the issues that we're going to talk about later with respect to 1045, 1244, all of the offshoots of this that have issues that have been caused as a result. So one of the key problems that I would say causes this is we've got QSBS, meaning we have founder shares in a company, or we were early investors in a company that had less than $50 million in assets at the time that I got my original issue stock. So let's say I'm a founder, or I'm an early guy or girl at a company, and now we're raising a Series B, and there's an opportunity for me to get some chips off the table, right? I want to take out 2 or 3 million, de-risk myself. There's an investor that's interested in buying it. The challenge that I see coming up is when I'm selling my stock, I'm selling my common stock that does qualify for QSBS. Oftentimes the investor doesn't want to buy that common stock, because as we may or may not be aware, when investors come around in the Series A or Series B round, they're investing in preferred stock, not common stock. So in our previous discussion, we talked about preferred stock and what the thought process around that was. In this case, that's one of those mismatches where I want to be selling common stock in order to get QSBS, but the investor wants to buy preferred stock. And so we'll talk a little bit more about the issues that are generated there and the way to solve that problem.
And then, Hall, if I can add, one of the things that we're
Chris.
seeing, or that we saw as we were fundraising, even for Rocket Dollar, is that when an entrepreneur goes out to fundraise and bring in new capital, seed, Series A stage, where this is most relevant, the standard documents that law firms are now using with fundraising for clients, such as startups, is now asking the founders to rep and warranty in the actual documents that you're going to maintain QSBS status for as long as possible. So this is something that's now showing up in the legal docs that an entrepreneur has to agree to as they're fundraising with their preferred stock investors, or the investors that are coming into the round. So there is some sophistication starting to happen. I think to some extent it's the tail wagging the dog. It's the lawyers that are like, okay, I'm going to put this in front of the entrepreneur now on behalf of clients. So we are seeing that. That is something that's unique.
And just so everybody's clear on those little things that trip up, one of the things that I think Chris is talking about that the legal counsel is trying to uphold is there's transactions that we can enter into that could trip it up. But additionally, 80% of the assets or the business need to be used for the active trader business. And what we saw during COVID, and certainly it happened outside of COVID, but companies had to reposition themselves in order to survive. And so they did things or made investments or did things that would be potentially considered non-core to the active trader business and could have potentially jeopardized the treatment of the qualifying small business stock. And so that's something that we're now seeing the knee-jerk reaction to legal documents stating that, basically don't do those things if they are going to disqualify us for this treatment.
Great. So for our audience, QSBS stands for Qualified Small Business Stock, and there are requirements around that with legal entity and deal structure. Joe, can you talk about what those rules are?
Yeah, they have to be a C Corp. As I said, they have to be in the business of making and selling something. That sounds pretty pedantic, but it does cause a lot of questions as to who does qualify. The term sheet itself, the security that investors are investing in, has to be an equity instrument, is the language of the law, and that means common or preferred. So safe notes, for example, if they're truly a debenture, don't qualify. Now, there are features of safe notes I've actually seen, and Matt, you may have seen it, and Chris, you as well, where they're saying this is a safe preferred, so they can get QSBS treatment. And that's really critical to keep in mind. So for those entrepreneurs that are getting counsel to float a safe note, your counsel probably doesn't understand QSBS laws, because they're literally hindering both your outside shareholders to benefit from either 1244 or 1202 by floating a safe note that doesn't have qualifying character traits as an equity instrument. So you can have all the same features of a safe note, open-ended pricing, interest rate that accrues, all that sort of stuff, but just call it a preferred. So it has to be an equity instrument. And again, the thing that where a lot of questions arise is, does my business qualify? Does it fall within the context of making and selling something? And that's, again, most startups that are seeking outside capital aren't lifestyle businesses, aren't service businesses. So it's almost a default answer that if you're a C Corp, you probably qualify, as long as you float the right term sheet, an equity instrument, which again, should be a preferred.
Yeah, and we should also mention that what was really popular for a long time was the convertible note. And the convertible note itself typically converts into equity when there's some conversion event, which is typically a certain amount of money raised. And convertible notes would not count either until the conversion actually happens, and now you're holding some form of stock.
That's right.
Yeah, that's a perfect segue, I think, into Hall's next question, which is going to be the rollover, right? Is that the last piece of the QSBS is assuming that we meet all those characteristics. It's original issue stock. We've held it for 5 years as C corporation stock. So either converted from an LLC into a C Corp, and that we've waited 5 years since the conversion. We've been accelerated, and we've been not converted from an S corporation, but acquired by a C corporation, the assets of an S corporation. And we've waited 5 years. We're going to qualify for this if we sell those shares. But the question often comes up, man, I don't control that. I'm so close to the end here. We're at 4 years and 2 months, and we're selling the company. So I check all the boxes along the way, but I can't hold up the deal 10 months. And so I think that leads well into Hall's next point that he wanted to discuss.
That's right. So we want to talk about the 1045, the rollover. Let's talk about how that works in this case. Joe, you want to take the lead on that?
Sure. And again, those of you that are familiar with 1031 and where you can roll over real estate, it's similar. And what this essentially allows for is under 1202, we're not talking about 1244, which we'll get to, I hope, but 1202 where profits can be potentially tax-free, but you have to hold it for 5 years. Well, what happens under Matt's scenario where it sells before the 5-year window, and that's what makes sense, is go ahead and sell it. The shareholders can take some or all their profits and reinvest into another QSBS transaction. And the phrase is they carry forward their date of acquisition of the first deal that got the exit, but inside the 5 years. So they carry forward actually their date of acquisition and cost basis, which means that now the money you roll over into new 1202 deals, if you had 4 years on the first one where you got the exit, you now only need a year of holding that new stock and then having an exit. And now you have a total 5-year hold between both transactions. And now you're in that tax-free window. So what makes it better than a real estate 1031 exchange is you can actually, in that example sale, you can take some money off the table. You don't have to roll over all the proceeds like you do in real estate. And you also don't have to roll it over into one investment. You can actually take your profits from a 1202 deal and maybe take your cost basis out and give yourself a 2 or 3x win, but roll over all those extra profits beyond that into a portfolio of 1202 deals. And now if any of them have an exit within that 1 year, additional 1 year holding period, as we talked about, now that's tax-free, and any of the others. So you can diversify your profits that you would have off an exit, but still be able to take some money off the table and book a win, and then roll over the house money, as I like to call it, and diversify. And so, but you only have 60 days to do it. And that's what makes it more difficult than real estate. I believe real estate, you have 180 days to find a property and then roll over all your proceeds. This, you only have 60 days to do it, but you can take profits, take money off the table, your cost basis, some profits, and then also diversify across multiple 1202 qualified term sheets to hope any of them or several of them have an exit, and thus you're in the tax-free nirvana.
And Chris, do you have anything you want to add to that?
I'm sorry, who?
Chris?
Matt? Paul?
Chris?
No, I've
Matt?
got nothing to add to that. Joe's explanation was
Okay.
great.
Great. Matt, what did you want to add to that?
No, it's perfect. I mean, that's exactly what it is. It's the rollover. And so that was very well explained.
That's great. Well, the other one on the table is the 1244 ruling, and wanted to cover that. That was on the plan, so glad we're going to get time to do that as well. Matt, what can you tell us about the 1244?
The 1244 is one that sounds very exciting and could be neat if I've ever had anybody qualify for it. So Joe asked me about it before the call, and it's funny enough, as he had mentioned earlier, QSBS has been around since 1993. And between 1993 and around 2015, I had 0 clients qualify for QSBS and 0 that really took advantage of it. It just wasn't meaningful. And so I feel somewhat similar to that with the 1244. When you hear the rule, you're going to be like, it's awesome. And then when you hear the qualifiers, you're going to be like, maybe, I don't know. So in any case, in order for me to explain this to you, you'd have to understand the way capital losses work. So if I make an investment into any stock, public, private, whatever, and I lose $5,000, and that's the only transaction I entered into during the year, the IRS allows me to write off $3,000 of that loss. So lost 5, they only allow me to write off 3. That $2,000 gets carried forward indefinitely to either be used as a $3,000 a year or to offset other gains. And it's because the federal government doesn't want to be in the business of financing losses that you're going to make on risky investments. So the same holds true when we make these early company investments, right? If you invest in XYZ startup and you put $100,000 into it, it's akin to buying any other stock or any other security. And if it goes bad, you're limited to $3,000 a year, except for enter section 1244. If this small business was a C corporation or an S corporation, and when you made your investment and you received back your stock, the total value raised was less than $1 million, and the company subsequently goes under, you can write off the entirety of your investment up to $100,000 for a married couple, and you can use it to offset ordinary income. So the $100,000 becomes fully deductible in the year that the stock becomes worthless, or you exit the stock at a loss of $100,000.
Now, this is really important for any entrepreneur on this call that fashions their startup as an impact potential startup, because the deductibility Matt talks about is what's called above the line or above the adjusted gross income line deduction. And that means that that's a better write-off. If you invest in a startup, let's think of it as an impact startup, and it fails, then that taxable investor gets a better tax deduction by writing off their 1244 loss than if they gave the same money to a nonprofit and got their charitable deduction, because that's an itemized deduction or below the line, below the adjusted gross income line. So this is a powerful way to raise money for that hard money, the seed money. That first $1 million is all that qualifies for now. And I want to talk about that because I've been lobbying for 5 years to get QSBS. 1244 has been around since 1958. It was the first 1202 borrowed the definition from 1244. It was passed in 1958. And back then, in 1958 dollars, it allowed for the first $500,000 to qualify for this favorable de-risking tax treatment. And then in 1978, they said, wait a second here, we need to adjust those levels because of inflation. So they simply indexed it to the current level of $1 million. So we're literally operating under the same in 1978 dollar terms. So I actually been lobbying to get 1244 indexed again to inflation. Just do exactly what they did in the Revenue Act in 1978. And if so, then it would be the first $3.8 million would get coverage under 1244. Right. All the money that would be part of the first $3.8 million coming in would have this de-risking, the ability to write it off against taxable income. Right. And that amount would go from $100,000 to $380,000. If you simply index that level as well.
We have a question, guys. Is it the first $1 million for each investor or first $1 million for a startup?
For the company.
So it's for the startup then. I got you. Thank you.
And then guys, if I can lob in another question. So nobody raises a round anymore at less than $1 million.
I know.
So if the first round comes in and let's say they raise 1.2 or 1.5, which we do often see. So tell me about that. Does that count or not?
Nope.
Well, yes, it does, Matt. I'm going to take exception here. What you can do, the law allows you to either prorate it across the full 1.2, so everybody gets 80% of their investment, that deductible gets, or they can allocate the first $1 million to get that first $1 million in if they're raising $1.5 million. So the last $500,000 doesn't get it. The first $1 million can. You can prorate it across.
That's what I've seen is in basically two tranches, and it creates some rife. Again, when you ask the question about what should early stage companies know about it, it's important that they're aware of it. And as Chris alluded to, I don't have many companies that raise below $1 million, even in the seed round of financing. It's typically 1.2, 1.5. And so you could see if it was raised to 3.8 million, a huge swath of companies and their investors would qualify, and it would be a utilized credit.
Oh yeah, it'd be. Very few people know about 1244. I mean, I talked to Bobby Franklin and Justin Field, who Justin's the head of the tax policy at the NBCA, and Bobby Franklin's the president of the NBCA. And Justin nor Bobby even knew about 1244. I mean, they lobbied to get 1202 to the current thresholds and levels and limits back in 2009 all the way through 15, but they didn't even know about 1244. And that's why most people don't even utilize it, and lawyers don't even put the legend in the term sheet or even understand how to allocate it, because it literally is just so grossly overlooked.
So this is another question from the audience. We are a 1202 IRC compliant early stage educational game startup. As we started to fill out interested investor requests, they're asking for details about our possible exit strategy down the road. Do you have any advice from a tax perspective as to how to respond to them on this? Matt, how would you coach them on that?
The biggest mistake that's made along the way is, number one, not recognizing that if we have redemption events along the way, people sell out, people buy new stock, we issue certain securities, it could exempt us from getting the treatment. So number one, talk to them about the fact that you're knowledgeable about those things and you would never do them. And number two, the thing that oftentimes people don't realize until they're in it is there's two ways to sell a business and thus two ways to buy a business. There's multiples, but we'll talk about two. I can either say, Hall, I love your company so much, I want to buy your stock. So you got 100 shares. I'd like to buy those 100 shares from you for whatever, and you're worth billions. And I give you that and I take your stock over. And that's one way. That's a stock transaction. That does qualify for QSBS because you're selling me your stock. The other way is, Hall, I love your company and I love everything you're doing. So here's what I'm going to do. I want to buy your customer list, your intellectual property. I don't want your building. I don't want your payables. I'm just going to give you $100 million for these specific assets. And that's considered an asset purchase. And that does not qualify for QSBS. So we have to be mindful of the way that we intend to exit the company and talk about the fact with the investor that we're very well aware of these things as a potential negative outcome.
Yeah, if I could eject, again, I manage money in the multifamily office, and you never had tax policy drive your investment strategy, period. But you also don't, everything, especially the wealthier the person, the more they're always looking at the after-tax implications of all decisions. And so when it comes to a transaction, if you're at a 4-year, or Matt's earlier example, 4.2 years, I might even go to the buyer and say, look, let's close on this date, and I'll give you a little bit of discount on the price. Because if you work the math out for the founders, if they can get QSBS treatment and $10 million, the first $10 million are tax-free, they can lessen the price because their after-tax proceeds will still be higher if they can get QSBS treatment for them and all their shareholders. So you can even use it as a negotiating tool in the transaction and structure it as such that you could say, look, commit, be patient, we'll close out at this window, but because we want to qualify for the 5-year holding period and just make it part of the negotiations as well. And everybody can win in that process. You can give them a lower price than they're willing to pay, and the shareholders can get a higher after-tax proceeds.
And then just in general,
go ahead, Chris.
Just in general, when an investor's asking you about an exit strategy, they're probably not anticipating that you're going to reply with tax strategy. So seriously, so just have in mind, like, what do typical ed tech startups do to exit? Do they get bought by other ed tech companies? Do they get bought by publicly traded companies? Is this a private equity? Are you going to be part of a roll-up somehow? So just make sure you understand what's happening in the nuances of the market in the industry that you're in.
For sure.
Good point. Next question is, does this apply to VCs? Do they qualify for it? Or is this just for angels only? Who does this apply to? Joe?
Anybody. Go ahead, Joe.
A venture fund is a pass-through entity. So all taxes pass through the LPs. So it's irrelevant whether you're investing directly or you're a taxable LP in a venture fund. And this is one of the real crimes in my opinion, the venture world, because they are required to capture all relevant tax implications on the K-1s of venture funds for their taxable LPs. And they don't do it. I asked Bobby Franklin, why don't more VCs capture 1202 and 1244 on the K-1s? They're required to. It's their fiduciary responsibility as GPs. That's the law of partnership structures. And he said, I don't know, it pisses me off. They're just effing lazy, was Bobby Franklin's words. So the fact is, yes, they are supposed to capture this by the governing laws of any partnership. As the GPs, they're responsible for capturing all relevant tax information. They can't claim that their accountant didn't know, because the accountants aren't the GPs. They need to hire accountants that do understand, like Matt, about QSBS and are on the lookout for the taxable LPs in a venture fund.
So if you're in a convertible note deal right now, how do you move that over to be a QSBS? How do you go to your investors or to your startup and say, I really need to get this moved to an equity deal? How do we do that? What's your coaching on that, Matt?
I mean, I don't know what the specific agreement reads, but you've got to convert it. You've got to hold equity. That's the biggest problem is it's made for equity investments in C Corps. So short of holding that, you got no shot. So it's hard to give advice in that specific case, but you can go, and what always works best is the truth. Hey, by not negotiating this instrument and by not getting this done, it potentially is going to cost me $2.8 million in tax. So I have a vested interest in getting this done, right? And I don't know who you are to that company, but if you're an important employee, investor, somebody, you would hope that they would have that conversation with you.
Well, so we went through this. So our first raise for Rocket Dollar was actually a convertible note. And then after looking at some modeling of what the interest was going to cost us over time, like we decided to just raise a seed round, a priced round, and convert the note into equity as soon as possible. And so when the note closed, we just kept raising.
Yep.
So there wasn't a period where we stopped. We just went out and said, you know what, let's convert this thing immediately. And QSBS was a consideration. Thankfully, Joe had taught me about this stuff. And so I said, we got to get converted ASAP. And then by then we started, because it was a priced round, we started looking at docs from professional venture capital investors. And I think one of them at that point had actually had QSBS as a representation and a warranty in the docs. So it worked out for us. But yeah, I would tell entrepreneurs that are raising capital to really understand the ins and the outs of this, so that it makes you look more sophisticated. Your investors are going to be like, this guy or this gal knows what they're doing. And I feel confident writing them a check. So convert those notes ASAP, because the interest does start to rack up eventually too.
Yeah. A couple things as well. And I've got clients that have used this effectively, in that the 1045 exchange has a 60-day window where somebody that got an exit can roll it over pre-tax. And so if you're out there raising money and you're QSBS qualified, then you want to lead with this. We're 1202 qualified. So if anybody wants to do a 1045 exchange, these are our traction points. This is a due diligence vault. You can do the due diligence in 60 days. Make it easy for people that have 1202 exit proceeds. We had a client that he was supposed to raise 2 million. He closed 5, and I saw it inside a month. I saw it in TechCrunch. I called him and said, Jeremy, how did you, I thought you were raising 2 million, you got 5 million. He says, Joe, I could have taken 7 because we had all this hot 1045 exchange money these VCs were just throwing at us. And we limited the amount we took because they didn't want to have to pay taxes on an exit they got inside that 5-year window. And this is some of their existing investors that added to their existing investment. But because they had an exit, they want to reinvest pre-tax, but they only had 60 days to do it. So you can create an urgency of time without it being one of these false senses of urgency that entrepreneurs are coached to try and create. You literally have a 60-day window that an individual investor will have imposed upon them by the tax law. And so they have 60 days to make a decision. So it can accelerate the planning process just by awareness and messaging it properly.
So the next question that came in is the $1 million raise limit, irrespective of the valuation of the company.
Yes.
Correct.
Okay.
Yeah.
The answer is yes. All right.
For 1244, yes.
1244 is what he's asking about. Yes, that's right.
Yeah.
Okay.
So I got a question for Matt, if I can ask one, Hall.
Go ahead.
You said something earlier, and I've gotten this question. I don't know the answer. I'm not a CPA. Can an LLC being taxed as a C Corp, would that qualify? And S Corp as well?
Yeah, you have to have physical shares of a C corporation. So yes, and what most are doing is converting into C corporation. So it's worth backing it up 2 feet. The exemption is the greater of $10 million or 10 times the adjusted basis in the stock. So what I advise a lot of early companies to do is begin as an LLC at a time when you can flow losses through to the early founders and the early money, and it's small, controllable, and you pass the losses to yourself. When we go to raise our first round of money and we convert into a C corporation, first of all, yes, it starts the clock on the day of conversion. So if you're an LLC taxed as a C Corp, yes. Or if you're an LLC converting into a C Corp formally, yes, as of the date of conversion or as of the date of election. So you could get at a time when the company's valuation is, let's say you're an early founder, you own 50%, the valuation is $10 million. You have an asset value of $5 million. Your exemption is now $50 million in that stock. It's 10 times the adjusted basis in your stock. So all that to say, it's important to be mindful of the organizational structure at the outset and get the best tax benefit in the early days, and also be mindful of the conversion to capture a greater than $10 million exit exemption.
Another point, Hall, that I've had on this topic is option holders, board of directors, advisory board, people that have options. And Matt, this is where I'm starting to get a little bit over my skis, so correct me anywhere in here, but it's my belief that if they do an 83B election on their options, now they've established a date of acquisition and cost basis, and thus option holders can actually benefit from the QSBS, but they have to do an 83B election. Matt, how do they do?
We actually don't. Yeah, we don't see many 83B elections any longer. What we're doing is seeing the actual physical exercise of the stock. And it depends whether it's an ISO or not. So there's very specific rules. Like this is a whole practice area in and of itself. So you can issue ISOs to individuals. There's a limiter on that where if greater than $100,000 worth of ISO value becomes vestable in a single year, you're disqualified on their NQSOs, in which case you actually have to buy the stock. You actually have to exercise your option, and then you can get qualified small business stock treatment. But there's another world where the ISO gives you capital gain treatment without any early exercise. So there's more in there than is able to be, unpacked.
Yeah, but a simple way to do that we have seen is if you're issuing NSOs, you make them early exercisable. The employees, the advisors, the board members, even early employees can exercise, file the 83B, actually take possession of the stock, and then from that point they started the timer. So that can be that's the technique actually that we practice internally.
Yep.
Great. So next question from the audience is, how do you find VCs who are looking to roll over their previous investments? Is there a way to figure that out?
Nothing that I'm aware of. Look, we talked to 407 firms when we did our Series A. And seriously, we have this stored in a CRM. I got all the data in case anybody's curious. And this conversation came up literally with nobody. There was an individual investor who just happens to be a CPA and works at Ernst & Young, who started talking about, or used to work at Ernst & Young, who started talking about QSBS And that was the only person in a raise where we literally talked to 407 people.
Yep.
Oh, great.
So
The
probably
next question
not.
is probably it can be tough. I maybe you'll look for those who have recently had exits and then track back to see who had money in there. That's quite a bit these days to see for sure. The next question is, I presume these tax advantages are only applicable to investors and startups based in the U.S.
Correct.
I
believe that's the
You have to be filing a U.S. return to get
filing, right? Yeah, if you have earned income or you're filing a U.S.-based tax return.
Yeah.
We have
And
one or
US-based
two
companies.
U.S. based companies. We have 1 or 2 minutes left. Does anybody want to talk about any state tax credits that you think are applicable? No, it doesn't talk to the entire group, but any key words there in the last few minutes that we have here?
I would be looking for the angel investor tax credit. I can speak specifically to New Jersey. New Jersey refunds 20% at a minimum of the invested amount in a New Jersey tech company every year by way of, it's an estimated payment. It's a very simple thing. And so those programs exist. They don't exist in New York. There's a small one in Connecticut, just in my, immediate practice area. And it's very, Connecticut, I see this, Connecticut does 25%. The New Jersey thresholds are very high, however. The New Jersey thresholds are, I believe, currently $500,000 per round. So it's a meaningful amount of return of capital.
Great. Well, I want to thank you guys. We'll go ahead and start to wrap up the panel here. To the audience, I understand this is a very complex topic, had many questions that came in today and many expressing interest in learning more. And so we'll be back in touch with you to give you more detail about your specific case and can take this that may have come by pretty quickly into a more detailed format. And so we'll be reaching back out to you. But with that, I'd like to want to thank our panelists today, Chris, Matt, Joe. Thank you for your time, your experience, and your perspective. And with that, we'll go ahead and pass it back over to the KiwiTech team, and looking forward to seeing you guys next time. Karandeep?
Thanks for having me.
So much. Thank you
Thanks
so
for having
much,
us on.
Matt and Joe. Thank you so much. Well, on behalf of hundreds of our guests today, we sincerely thank and appreciate all the wonderful insights and perspectives that were shared by our panelists today. And thank you, everyone, for that.